Dear students, today we are going to discuss basic terminologies, accounting principles, concepts, and conventions of accounting, basic accounting. What are the basic principles? Different methodologies, different terminologies used in accounting, concepts, and conventions, basic conventions of accounting. Okay. What are the main objectives of this learning is you should be understand the basic terminologies of accounting first, since you are new to this accounting field or the commerce field. You should be able to understand what are the basic terminologies used in accounting. Then what are the basis of accounting? Basis of accounting. Then accounting principles. Principles, as you know, these are the basic principles, postulates based on which the accounting is built. Then basic concepts and conventions of accounting. Okay. First, we are going to familiar with certain terminologies in accounting. First, what is a business transaction? You may have heard about the transaction. Here, what is business transaction? Business transaction is exchange of money or money's worth as goods and services between two parties is called a business transaction. So it is an exchange of money or money's worth as goods and services between two parties is called a business transaction. It may be transfer of goods and services. It may be in the form of money's exchange or money's worth. There should be an exchange. That is a business transaction. Business transaction may be cash transaction, credit transaction, or non-monetary transaction. Cash transaction, what is cash transaction? A transaction that is settled with cash on the same day as the trade. Okay. Then what is credit transaction? But the payment of a receipt of money is postponed to a future date. Yes, right. You may know cash and credit, two transactions. In the case of cash transactions, that transaction is immediately settled by paying cash or money. In the case of credit transaction, the payment or the payment of money or cash is postponed to a next or a future date. Okay, there may be some non-monetary transactions also in business. The transaction that does not involve an exchange of money or money's worth directly or indirectly. That is non-monetary transaction. Actually, non-monetary transactions are not all considered or can be recorded in accounting. Okay, then next term commonly used in accounting is goods. Goods. What is goods? What are goods? The commodities or articles in which the trader deals with. A particular trader or a businessman, he is dealing with certain commodities or articles or products that are called goods. You should understand that goods, the commodities that are dealt with. The businessman deals with the certain commodities or that certain commodities he purchased from somewhere else and he resell it to the customers. So that they are the goods. They are the goods. That means you should understand that if he purchase a furniture or an asset, that does not come under the term goods. So the goods means the commodities they are purchased for the purpose of resale or for the purpose of manufacturing. Okay, they are called goods. Then profit. You may have heard the term profit, but profit in accounting, profit means income over expenditure during a particular period. During a particular period, where the income is more than expenditure, that is called profit. There are so many kinds of profit. There are different kinds of profit that we can see later. Okay. There are there are certain profits, operating profit, non-operating profit, normal gain or abnormal gain. Then there are certain that kind of terms that we can learn that kind of terms later. Here, you should understand what is profit. There are different kinds of profit that we will discuss later. Okay, income. Income, that is another term that is used very common in accounting. It is a revenue arising as a result of business transaction. It is revenue arising as a result of business transaction. Business transactions, we have already seen that there are business transactions. In certain transaction, revenue is generated. That is called income. Okay. Then next is the term you might have heard, assets. What are assets? Assets means property or any kind owned by a business. Owned by a business. Okay. Property or any kind owned by a business. Assets are different types. Fixed assets, current assets, tangible assets, intangible assets, or fictitious assets. Okay, fixed assets. These kinds of there are different types of assets. Detailed classification we can discuss later. So you should understand that asset means a property or any kind owned by a business. Owned by a business. So you should understand the difference between goods and assets. Goods are the things or articles the businessman deals with. Assets are the business, the properties owned by the business. The ownership is by the business. It is generally fixed assets, current assets, fictitious assets, tangible assets, intangible assets, wasting assets. There are so many kind of assets. In the case of fixed assets and current assets, we are usually deals with fixed assets and current assets. Fixed assets means the assets acquired for the purpose of long-term use. Current assets for short-term use, buying and selling. Okay, for the short-term use. Okay, that we will see later. The next term is usually used a term that is liabilities. Liabilities. What are liabilities? The amount payable by the business to others. The amount payable to others by a business firm. Okay. In the case of assets, we have different kinds of assets. Similarly, there are different kinds of liabilities also. Liabilities may be fixed liabilities or long-term liabilities or current liabilities or contingent liability. Here, we are discussing only with that basic terms. We will discuss in detail later. Okay. Fixed liabilities or long-term liabilities and short-term liabilities or current liabilities. Other kind of liabilities are also there, that is called contingent liabilities. Contingent liabilities are not actually liabilities, but that may occur as a liability on the basis of that is uncertain actually. Contingent liabilities are actually uncertain. That may become an actual liability on the happening or non-happening of certain events. That events are uncertain. So we cannot predict that liability may or may not arise in future. That kind of liabilities are called contingent liabilities. Okay. Then next term is net worth. Net worth. What is net worth? Net worth is excess of assets over liabilities. We have already discussed what are assets, what are liabilities. So the excess of assets over liabilities is called net worth. Simply. There are so many other interpretations of net worth. We don't need to go that kind of interpretation. You just understand that net worth means excess of assets over liabilities. Okay. Then capital. What is capital? The total amount invested by the owner into the business. The amount invested by the owner into the business. That is called capital. Then drawings. Drawings means withdrawal. Withdrawal of the owner from the business. Suppose withdrawal may be in the form of goods or in the form of money, or in the form of any other assets. Okay, that is called, all these are called drawings. That is, the owner withdraws money or assets or goods from the business, that for personal use, for his own use, not for the business use. For his own use, he may withdraw money from business to pay for his personal liabilities. That is called drawing. Next important term that usually used in business is debtors and creditors. Who is a debtor? A debtor means a person who owes money to the business. Who owes money to the business. Okay. So who is a creditor? Creditor means a person to whom money is owing or payable by a business firm. Creditors are the money whom money is payable by the business. Okay, they are called creditors. Okay, okay. Then next term, expenditure. Next term actually used is expenditure. An amount paid for any consideration received by business is called expenditure. Expenditure may be capital expenditure, revenue expenditure, deferred revenue expenditure. Okay, that we will see later. Then discount. Discount. You might have heard this term discount. What is discount actually? It's a concession given by a seller to the buyer. It's a concession. You might have received a discount from, when you purchase something from a business firm, from a shop. You might have received any discount, right? So the discount may be cash discount or trade discount. That we will see later. Okay. Next, solvency, insolvent and insolvent. That kind of classification you might have here: a solvency and insolvency. Who is a solvent person? A person who is in a position to pay all of his debts. A person who is in a position to pay all of his debts. That is, his assets is more than his liabilities. Then he can pay all his debt, right? So he is a solvent person. So who is an insolvent? Insolvent when his liabilities are more than his assets. When his liabilities are more than his assets, then he is called an insolvent. He is not in a position to pay all his liabilities, right? So he is an insolvent. Then another terms used in business is accounting year. Usually accounting year is a period from April 1st to March 31st of the next year. Then trading concern, then goodwill, that kind of these are the basic terms actually used in business. Okay, you must familiar with this kind of terms that is commonly used in business organization. Okay, then